Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our tanker market update for September 2022. Now, last time I spoke to you in June, the tanker market had become completely inverted, with product tanker rates averaging higher than crude tanker rates and VLCCs being the worst performer of all. Now, in the 3 months since I've spoken to you, all tanker rates have firmed across the board, which is very encouraging. So right from VLCCs down to MRs, the tanker market has been very firm. And this strength in rates is primarily due to increasing ton-mile demand as a result of Russia's invasion of Ukraine, but also is reflective of positive underlying supply and demand fundamentals. So starting with Russia, I think the increase in ton-mile demand that we saw developing earlier this year has proven to be very durable. So if we look at the situation pre-invasion, Russia was exporting about 2.7 million barrels a day of crude oil to Europe, predominantly on Aframaxes and Suezmaxes. Since that time, Russian exports to Europe have gone down by about 1 million barrels a day, and that oil instead is being sent long haul to Asia, in particular to India and also to China, on a mixture of Aframaxes and Suezmaxes. So that's been very positive for mid-sized tanker ton-mile demand. At the same time, Europe has had to backfill the crude that it was getting from Russia from other sources, primarily from the United States, and we're seeing that US crude exports to Europe are at their highest level ever. It's also coming from Latin America, so Brazil and Guyana, as well as West Africa and the Middle East. And again, these are regions that typically tend to be load regions for Aframaxes and Suezmaxes, so it's really benefited the mid-sized sectors. Furthermore, this redrawing of trade routes hasn't finished yet. So looking ahead, the EU is set to ban all remaining imports of Russian crude oil from December 5th and all remaining product imports from February 5th of next year. And at the moment, Europe is still importing about 1.6 million barrels a day of crude from Russia and about 1 million barrels a day of refined products, mostly diesel and gas oil. So as that ban comes into effect this winter, that again is going to force more Russian oil longer haul. And again, Europe's going to have to backfill from elsewhere. So it's going to cause a lot of disruption and should give a big boost to tanker rates over the winter months. Now, up until recently, the VLCC market had been lagging well behind Aframax and Suezmax rates. And that's been primarily due to COVID lockdowns in China, which has meant that, especially this spring, we saw very reduced Chinese oil demand and a big drop in Chinese crude oil imports. And although the zero COVID policy is still in place and we can expect to see ongoing disruption while it is in place, we are starting to see an increase in Chinese crude oil imports as those restrictions begin to ease a little bit. And more importantly, we've seen an uptick in long-haul oil movements from the Atlantic into Asia, especially from the United States, where crude oil prices, such as WTI, have been trading at a big discount to other grades, such as Brent or Dubai. So that's really incentivizing Asian buyers to take long-haul barrels from the US over to places like China, which has been a big driver of VLCC ton-mile demand over the past couple of months. So it's been really encouraging to see VLCC rates come back and no longer acting as a cap on Suezmax rates. So that's helping the whole crude tanker segment. In addition to the disruption caused by the EU's ban on Russian oil imports, we're also seeing additional oil demand this winter due to gas to oil switching, particularly in Europe, where reduced supplies of natural gas from Russia have caused energy prices to go to record highs. And so what we expect this winter is that a lot more power generation will come from oil, and also industries will turn to oil for their energy as well. So the IEA expects that oil demand will be boosted by about 700,000 barrels a day in Q4 this year and Q1 of next year, which will provide further support to tanker rates over the winter months. Looking further ahead to next year, the IEA is currently forecasting oil demand growth of about 2 million barrels a day next year, surpassing pre-COVID levels for the first time and reaching a new record high. This growth will be mostly driven by Asia, and in particular China, where an expected easing of the country's zero COVID policy next year should result in a renewed increase in oil demand and therefore oil imports. However, we must acknowledge that there is a significant degree of uncertainty with this outlook, particularly due to the uncertainty over the health of the global economy and the threat of recession in the coming months. Now, a steep economic downturn or a widespread recession may cause oil demand to be lower than is currently forecast. However, we do believe that the tanker market will remain relatively strong, even in the event of a recession, due to both the redrawing of trade patterns as a result of Russia's invasion of Ukraine, which I just talked about, but also due to very low fleet growth. And these very positive fleet supply fundamentals, which we've talked about pretty consistently for a few months now, remain intact. So high new building prices, which are currently at the highest level since 2009, and a lack of shipyard capacity, with yards full well into the second half of 2025, has led to very low levels of new tanker orders this year. And as a result, the tanker order book, when measured as a percentage of the existing fleet, has dropped below 5%, which is a record low level. In addition, the tanker fleet is aging, with a significant number of ships set to reach age 20 in the coming years, and which could face phase outs. So as such, we're pretty confident that tanker fleet growth will be very low for the next 3 years, with less than 1% fleet growth projected in 2023 and negative growth in both 2024 and 2025, as the number of ships exiting the fleet is expected to outweigh new deliveries. So in sum, we're confident that the tanker market will remain very firm over the next 6 months due to the upcoming EU ban on Russian seaborne oil imports, as well as elevated oil demand over the winter due to gas to oil switching. And while there are concerns about the trajectory of the global economy over the next few months, we do believe that longer voyage distances as a result of trade route disruptions, as well as very low fleet growth, will mean that the tanker market is well positioned for a period of strong rates over the next couple of years. So that's our tanker market update for September, and we'll speak to you again next month.